Hi everyone, this video is going to be on our investment forecaster feature. If you look at most of the features on analytics, they generally tend to look at the past performance, past volatility. They clearly look at the present as well, so we're looking at asset allocation and charges, etc. But there are very few features in analytics that does the reverse, the opposite of that. They look forward. One of those unique features is the investment forecaster, where it takes the asset allocation of whatever you're trying to review and it forecasts it forward and shows you the high, the mid, and the lowest probability of what that client can expect to achieve if they're taking on that level of risk. So it's a really good little solution to use beside your risk profiling tool, and equally just to try and get clients to understand the level of loss inherent in the sorts of solutions you're looking at with them. So to find it on the left-hand side under the Portfolio Tools tab, you'll find Investment Forecaster, and it will load up this little box or window, and it works like every other feature from left to right. So the idea is on the left-hand side, all of the portfolios will load up. So again, your model portfolios, maybe funds you've got on here, portfolios that you dragged across from a back office like IO or Xplan. We'll look at all of that. But they also have the attitude to risk levels in here as well. So we'll start with these. So those of you that are using the ATRQ in analytics, you'll know there are 5 risk levels and then 3 investment terms as well. It's the same with cash calc. So maybe for whatever reason, let's start with suggesting that I'm an advisor trying to explain to my client what a risk profile 3 would look like in the future, potentially, trying to give some kind of stats and data on that risk profile. So we're going to say, look, pull the asset allocation for risk profile 3, suggest my client's going to invest 300,000, and maybe I want to project that up over 15 years. You can mess around with these figures, of course, and we'll get onto some of the other options in a second. And what it does, regardless of what you're trying to look at, it does exactly that. It will take the asset allocation, project it forward, in this case over 15 years. It gives you a high, a mid, and a low. And the good way of looking at this would be, okay, well, it's unlikely, but if we had a 15-year bull run on every single asset type that we're looking at here, that's your best case scenario. Unlikely, but still possible. What about in reverse? What about if we had a 15-year bear run? Again, incredibly unlikely, but still possible. That's the worst case scenario. And then you've got a kind of a 50-50 chance of hitting higher or lower than that middle. So it's kind of like an average. And then there's a 5% chance of hitting anything outside of this graph. Again, very unlikely. So it gives you a broad range of returns. Now, that's including inflation. If you wanted to take inflation out of the equation, you can just simply base these figures on future value and everything shoots up as you'd expect. I won't do that on this demo. We'll just keep it in real terms. And then underneath will give me the actual figures. Look, that's the actual monetary value for my best case scenario, my worst case, and my mid case, chance of being cash, and chance of getting back less than you originally put in, only a 16% window, because you're looking at that asset allocation. Okay, now I want to start maybe comparing this against other things. Maybe I'm suggesting to my client, look, this is where you are at the moment. We think you'd be better off in a risk profile 4 solution. So before I start looking at the solutions, we can start adding something to compare. So what is that something? We'll start typing in attitude again. There you go, attitude to risk level 4, a 3 versus a 4. And just for the sake of it, I'll add a little goal in here as well. And maybe my client's hoping to achieve a 400k pot before they retire. Again, whatever the scenario. And if I run the analysis, it's going to run it on a fan chart initially. It's quite difficult to work out which is which on a fan chart because they kind of blend into one. So you can use some of the other, you've got 3 different visuals here. You can look at a pod chart, high, mid, and low. That's quite popular. Kind of the fatter the pod, the more likely the scenario. So very unlikely, a lot more likely in the middle. And again, there's that goal line at 400k, and also bars quite popular as well. Again, a high, mid, and low. And as I said, it's a nice way of kind of visualizing risk, because what do we mean by risk? We mean as we take on more risk, the difference between your highest and your lowest point is going to be wider. If you don't take as much risk, then clearly your highs are going to be quite low and your lows are going to be slightly higher. So you kind of get again, a narrower range of difference. So as you can see here, because we're taking on more risk, it means our highs are higher. We could end up getting more if there's a good, good market conditions, better on the mid, but also you stand to lose more as well. So again, a wider range of returns on a risk profile 4 compared to a 3. And again, the stats to back them up at the very bottom here. Chance of reaching your goal has gone up. Chance of beating cash has gone up, but then the chance of getting back less than what you put in has itself gone up as well, to illustrate that, because we've reduced the bond exposure. We don't have any fixed interest, and we've pretty much gone wholeheartedly into equities. So that's a very quick and easy way of comparing those risk profiles. And again, PDF when you're ready to generate a PDF of what we're looking at here. Let's change this up though. Let's suggest I want to start looking at my portfolios rather than just the attitude to risk levels. So maybe rather than looking at risk profile 3, my client already has a portfolio. My mate Keith Baker, there's his pension. And I want to compare that against my risk profile 4. And again, worth noting that Keith Baker portfolio could have been on Intelliflow, it could have been on Xplan or Curo or Transact, and I've just pulled that portfolio into analytics, and suddenly it becomes available to me on this feature. Or I could have built it myself, or it could be an MPS solution on our MPS directory. It's all the same logic. I've grabbed a portfolio, now I'm able to compare his portfolio versus a risk profile 4. And the clear differences between the two, fairly similar to what we just showed. Look, Mr. and Mrs. Client, because you're not taking enough risk, this is your range of returns versus what it could look like if you took slightly more risk on board. Now, I want to change that up a bit more. I now want to compare solution versus solution. So I'm going to maybe compare this against the Vanguard Life Strat Fund. This is just a one multi-asset fund. But again, if you want to blend multi-asset funds together, if you want to build your own portfolio, you can do exactly that. But I'm suggesting that this client will be much better off in a Vanguard Life Strategy 80%. Maybe that's a risk profile 4. And now I want to compare my risk profile 4 solution versus Keith Baker's portfolio. And I get a fairly similar range of returns as I did before. My Vanguard Life Strat's taking on a little bit more risk than my client's portfolio was or is at the moment. And therefore I've got a higher high, a higher mid, and a slightly lower low. And again, the figures to back it up underneath. So as you can see, it's entirely up to you. If you're not using our risk profile, that's really not a problem. This isn't built around our risk profiling tool. They just happen to be kind of baked into it if you are using it. But I can compare solution versus solution, solution versus risk profile versus risk profile, etc. And just lastly, these last two tabs here, let's switch this up a bit. Let's reset this back to, let's suggest I'm going to be recommending my client move into Vanguard, maybe a slightly different client. They've got 600,000. We're going to project that up over 20 years. Let's just set that up. And let's just move that to a fan chart. There we go. But this client's actually in drawdown. So, okay, they've got 600,000 now, but they're going to be taking an income from it. Now, in reverse, if they were putting money in, you can just add an annual contribution and say, look, they're going to be contributing £500 a month, £1,000 a month, etc. Or in this case, this client's going to be taking a regular withdrawal from it. So I can do a regular amount or a percentage. This is going to be about £1,000 a month. Let's just do £12,000 a year. I want that increasing at inflation or no increase inflation. I want that annual withdrawal increasing by national earnings, or I can set my own percentage, but I'm just going to say set it at inflation. And then I want the withdrawal to start today, or I can defer it and delay it by a certain amount of years. Maybe the client doesn't retire for another 10 years or 5 years, so I can delay the withdrawal up until then. But I'm just going to say now, and if I click on calculate, there we go. It gives me a new set of results and says, well, look, Mr. and Mrs. Client, with that 600,000 projected up over the next 20 years, you can easily take £1,000 a month, because when you look at the high, mid and low, if I scroll down a bit, you can see even the worst case scenario hasn't got you running out of money. You're still, and again, that's assuming a terrible 15-year of market growth. However, even if the markets are super strong, 2 million, and that's probably more what we're looking at. You've put in 600,000, you're able to achieve that £12,000 a year, and the underlying capital will still grow slightly up to 36,000. And again, chance of beating cash, chance of losing money, understandably slightly high because you're taking money out of it every year with that asset allocation. So there's lots of different uses for our investment forecaster feature. As I said, you can compare anything against anything with an asset allocation. Now, most things in analytics will have an asset allocation, so it shouldn't really be much of a restriction. And the final PDF will look a bit like this: your logo in the top left-hand corner, the inputs you've added, the results, and then some of the logic that we're using behind the scenes. What are some of the assumptions we're using behind the scenes to generate those results? So hopefully you found that useful. As I said, a very useful feature for lots of different scenarios. So any questions or any issues with any other parts of the system, feel free to reach out to us under Contact Us as our email and our phone number. Thanks for watching.